we'd like to welcome everyone to Eide Bailly's payroll and 1099 year-end updates for 2021. Myself, Kate Stenzo, Angie Ziegler, and Jillian Robinson will be presenting. Myself, Angie will be doing payroll, and Jillian will be doing the 1099 information. It's hard to believe that we're already at that time of year again, but I think we're all ready to rock and roll when it comes to this stuff. So our agenda for today is we're going to be planning for a successful year end, going through what can make for a successful year end so that we don't run into any issues, our year end compliance, and then what do we need to do for 2022 to start off the year on the right foot. So I'm going to kick things off here, and I'm going to start with the payroll part for planning for a successful year end. Okay, so planning for a successful year end, the payroll side of it. So to get started here, it all begins with that first paycheck that we process in the beginning of the year. If that first paycheck is incorrect, it can lead to employees not being paid correctly. Then it could possibly lead to payroll taxes not being paid timely or being paid correctly, which can also then flow into your quarter returns not being correct and possibly W-2s being issued wrong at year end. So as you can imagine, it doesn't take long to create issues if that first paycheck of the year is done incorrectly. So we've kind of put together like 5 steps here of what to do in order to have a successful year end. So like I said, the first step is processing that payroll, making sure that we have the correct rates for your employees, especially at the beginning of the year. If you offer raises at the beginning of the year, make sure hours are correct, deductions, especially making sure if your benefits change over January 1, do you have them set up correctly? Do you have the correct amounts in there? Do you have them set up correctly for the pre-tax versus after-tax deductions? And then it moves into the step 2 with the tax payments, making sure that's calculated correctly, that you're like for federal, that you're including both the employee and the employer portions of the FICA taxes, and that you're including the federal withholding. Step 3, you're moving into the quarter returns, filings with the federal and state, if state applies to the area where you have workers in, making sure that they're done timely. When are your due dates for those particular returns? And making sure the deposits for the quarters tie back to what you're actually filing on your returns. Then it brings us towards the year end where we're currently coming up to processing the employees' W-2s and W-3s. The year end statements need to tie back to all 4 quarters that have been filed previously. It's also important to tie out each quarter and then a year to date each quarter as well. So that way, if you come into an issue, say third quarter, something got voided in second quarter, if you tie out year to date in third quarter, if you're off, you could go back and fix that. So you're not having to do that come fourth quarter when you're under kind of a time crunch to get all those W-2s and the extra annual returns done throughout the year. So it's always good when you come into the fourth quarter to have a checklist here. And we kind of put together different items that we kind of thought were important to look at, starting in October and then moving into November where we're currently at in December. So I'm just going to touch base on a few of these just to kind of point out some things. So like in October, I know we're past that, but, even start thinking about it now, like where are we at? Could you potentially have an extra payroll in 2021? January 1st does fall on a Saturday this year. So if you plan to move that payroll check date back to the 31st, is that going to cause issues within 2021, especially for salary people? If it's an extra payroll, you could overstate their wages. And then you could understate them in 2022. For your deductions, did you have your deductions planned over X amount, 24 or 26 pay periods, that this could cause issues having extra deductions come out? Then you want to make sure your employees are verifying their information, making sure you have correct address updates for W-2s. Are people's social security numbers actually correct? Did something get miskeyed when they were a new hire? And we don't want to report that incorrectly to cause a W-2C. Start thinking about determining your taxable fringe benefits that need to be accounted for. Work with your AP department. Is there anything that the AP group has issued to your employees as payments that need to be actually added back on for taxable wages? Did the company offer gift cards to employees that need to be brought back on as taxable wages? Did you offer any kind of moving expenses that are 100% taxable now that need to be added onto a particular employee's W-2? Looking ahead, what's the holiday schedule? How is your company going to handle check dates that fall on a holiday? And then think about what the banking holidays. Do we need to remove check dates around because of banks being closed earlier, banks being closed all for the whole entire day. I'm reminding employees to look at their W-4 information. Are they needing to update it? As a reminder, anybody that's claiming exempt, in order to remain exempt, they need to fill out a new W-4 form by February 15th to remain exempt in 2022. And then when we move into November, we got the special accounting rule, which we'll go into a little more detail later on here. But for personal use of auto, that you can start calculating those, because with the special accounting rule, you have until from November 1st of 2020 through October 31st of 2021 for that calculation. And then moving into December, you want to make sure before your last payroll of the year, you want to have those taxable fringe benefits reported by the last payroll of the year, or you can add them on, any of the last payrolls within the month of December. Determining last payroll of the year and the first payroll of 2022, like we talked about, kind of a little bit with that first falling on a Saturday. And then verifying that no employees have a negative taxable wage or deduction that was going to cause issues with your W-2 when you go to run those. And then to remind yourself to pay the taxes on the taxable fringe benefits, especially if you're putting those fringe benefits on a off-cycle payroll, that they do follow the same deposit rules as your normal paychecks do as well. So kind of let's get started. We'll kind of start with the basics like we always do. What is gross income? Gross income is all income from whatever source unless it's excluded by law. Basically, we're talking about all income you earn before taxes and deductions. So you can kind of see some of the examples there of what we consider to be, income to an individual. Many people get the gross income and taxable income mixed up. Gross income is your income minus any pre-tax deductions. So the amounts that you see, your employees see on their W-2s don't necessarily match what their year-to-date amounts are on their last pay stub of the year, where we tend to get that question sometimes is, these two don't match, but then we have to explain to the employees that it's your gross minus your pre-tax deductions reduces your taxable wages that are on your W-2. So moving into taxable fringe benefits. What is a taxable fringe benefit? It's a form of pay other than your employee's normal rate that is considered compensation. We'll go over into more detail some of the specific taxable fringe benefits that reoccur every year that most people are familiar with. So what things to consider with your taxable fringe benefit? What gets included in an employee's paycheck? It's the fair market value of the items less any amount the employee paid after tax, any amount that's excluded by law. So not everything necessarily is taxable to the employee. And this is what we call the de minimis fringe benefit. And a lot of people try and assign a dollar amount to these de minimis fringe benefit. If it's under $25, under $50, under $75, they think, that's what they're going to use as their benchmark as not being taxable. But not in reality, the IRS has never assigned a value to this. It would need to follow the definition of being a de minimis fringe benefit in order to exclude it from taxable wages. Some examples of a de minimis fringe benefit, that you can see, your occasional, if somebody they bring in donuts to the office, or, you have a happy hour, or you give away sporting event tickets, it's the occasional items of those. That's the key word, as long as it doesn't happen frequent, or the same individual is having this benefit given to them. Remember though, that any cash that is given is always taxable to the employee, and this does include gift cards. So with fringe benefits, you look to handle these benefits as paid by the pay period, monthly, quarterly, or on any other basis, as long as you report the benefits as being paid at least annually. Any fringe benefit buying cash must be included income subject to withholding, depositing, and reporting when paid. To help with accounting for all the taxable fringe benefits, there is the option for what we call the special accounting rule that we mentioned in our checklist, which is where employers may elect to treat the value of taxable non-cash fringe benefits provided in November and December as paid in the subsequent year. And this is commonly used for the personal use of a company vehicle, which we'll discuss here in a little bit. If you do choose to use this method, it must be used for all employees who receive the benefit, and you must notify your employees that you're using this special rule. Then depositing the taxes on the fringe benefit, this will follow the same semi-weekly or monthly deposit period that you normally follow. So with the tax payments for the federal, we wanted to just point out, how do you derive at what deposit schedule that you are? So the rules on the federal tax payments, your deposit schedule is determined each year by what they call the look back period. So for 941 filers, it's July 1st through June 30th. And within that look back period, if your liability is 50,000 or more, you are a semi-weekly depositor. So if your checks are dated Saturday, Sunday, Monday, or Tuesday, your tax payments are due that Friday. And then checks dated Wednesday, Thursday, or Friday are due the following Wednesday. If your liability during that look back period is under 50,000, you are considered a monthly depositor, and your tax payment is due by the 15th of the following month. And then quarterly, if your liability is $2,500 or less, you're able to pay with your quarter return. So then, of course, the IRS has got to throw in an extra special rule, which I'm sure a lot of us are familiar with, the $100,000 rule. If your liability goes over this at any given time, your payment is due the next business day. And if you're a monthly depositor and you go over this $100,000 rule, it automatically triggers you to be a semi-weekly depositor for the remainder of the calendar year. And the thing you want to watch for, especially when we're coming into this time of the year where a lot of bonuses are processed, if you have a paycheck, you date your normal paycheck, say for a Thursday, and then you won't date your bonuses for a Friday. And if your liability goes over the $100,000 for those two check dates, because they fall within that same period, it does trigger you to have the $100,000 rule where your tax payments would be due the next day. Loans to employees. So are these taxable wages to the employee? These are not advances, which we have to be careful with that, not to confuse the two with those. This is money you have borrowed to your employee with plans that they would pay it back with interest being charged. If the interest rate charged to the employee is below the federal interest rate, then the difference is taxable wages and put on the employee's W-2s. So we have an example here on the slide here that if the employee receives a $20,000 loan, the interest rate is 2%, but the federal interest rate is 6%. So the difference between the 6 and the 2 is 4, and we take that times the 20,000, we come to the income being at $800 that needs to be added on to the individual's W-2. If the employer decides to forgive the debt, or for any other reason the employee is not expected to repay this loan, the entire balance then becomes taxable wages to the employee in the year the debt is forgiven. So even if they've paid off $5,000 of that loan, the whole $20,000 would be taxable wages to that individual. 2% shareholder for S corporations. Items specific to S corp holders. Any amount of the employer pays for health insurance and HSA on behalf of the shareholder is taxable wages to the shareholder and reported on the W-2. It goes in boxes 1 and 16 with a note in box 14 for that, for both health insurance and HSA. It is not subject to Social Security or Medicare taxes, and you do not need to withhold federal or state withholdings on these items. But you do want to make sure that it is visible in box 14. There's only so many line items that show up in that box 14, but you want to make sure that these shareholder add backs are visible in that box 14. And then group term life insurance, it is 100% taxable for 2% shareholders. They do not get that first 50,000 as tax-free. So one little different than the regular employees have for 2% shareholders. Third-party sick pay. This is always a fun one that a lot of payroll processors are not a fan of, but it is a great benefit to the employees to offer this. The biggest question with third-party sick pay that needs to be determined is how are the disability checks being taxed? If the employer is paying the premiums, then the employee will be taxed on the wages when they go out on leave. But if the employee is paying the premiums with after-tax dollars, then it's not taxable to the employee. The other items that need to be figured out is between the employer and the third-party company are the reporting requirements and who is doing what. Who's going to pay the taxes? Who is preparing the W-2s for these wages? If the third party is paying the employee's portion of the payroll taxes, then the employer is responsible for the employer portion. So the employer matches the federal or the FICA and Medicare tax. The tax depositing rules still apply on these payments. The third party will include the employee's portion of the taxes on their 941 return, and then the employer will include their portion of the tax on their own individual 941 return with the IRS. So for W-2s, if the employer is preparing the W-2, then the third party will fill out the form 8922, which is the third party recap form. This form is filed with the IRS and is used to reconcile for the year the difference between the 941 returns and the W-2s filed. If the third party is preparing the W-2s for the sick pay, then the employer's responsibility is to prepare the 8922, the recap form. The third party is not required to send their statements to employers until January 15th. So before you file your W-2s, if you get a jump start in early January, you want to make sure you've either reached out to the third party administrator or just know that if you don't have any, then you're okay to file the W-2s. But if you do, you want to wait till you get that statement. Otherwise, it's going to create issues where you need to amend returns and potentially fix the W-2s. So awards and prizes. Per the IRS regulation, prizes and awards given by an employer to an employee are generally taxable. Gift cards, this is always one that people don't think that need to be taxed, but the answer is they are always taxable to the individual. It doesn't matter the dollar amount. If they're $10, $20, $100, they're always taxable to the employee. Because you guys remember, cash is always cash. Company gifts given away, the amount that is taxable to the employee is the fair market value of the item if you were to go out and purchase it yourself, and it's not necessarily what the company paid for the item. Some of these items that are given away at like a Christmas party or a company picnic are sometimes donated to the company. So the company isn't necessarily paying anything for these items. So the dollar amount that would get added back, like I said, is the amount that if I was to go out and purchase this on my own, what the fair market value it is. And then coming up with this time of year, a lot of companies love to give out, let's say like a coupon or something, to go down to the grocery store and get a ham or a turkey. We get this question a lot is this particular item taxable? If the coupon just says it's good for one free turkey or ham, then it would not be considered taxable income to the employees. But if that coupon lists any kind of dollar amount that you can, spend $20 towards a ham or a turkey, then that would become taxable wages to the individual because it does list a dollar amount on there. So for safety awards and length of services, for these items to not be taxable, the award cannot exceed the following limits. For non-qualified plans, total for both safety and length of service for any one person cannot exceed $400 in a calendar year. For qualified plans, they cannot exceed $1,600 in a calendar year. And a plan is considered qualified if it does not discriminate in favor of highly compensated employees and is a written plan that's been put in place by the employer on a regular basis. For safety awards, it cannot be more than 10% of all employees may be entitled to this. The employee must be full-time with 1 year of service, but managers, professionals, administrators, and clericals are not eligible employees for this type of award. The length of service qualifications they must be a tangible property given. It must be presented in a meaningful ceremony. It doesn't have to be anything fancy, but it has to be, presented amongst a group. And also that must be done in the first 5 years of employment and then every 5 years from there. So if you do 5, 10, 15, and so on, then it becomes eligible. Personal use of a company used vehicle or company provided vehicle. If you offer an employee a company vehicle to drive, the business use of that vehicle is excluded from the employee's income. And any miles that are driven for personal use is considered taxable income to the employee and needs to be added back to their W-2. This would include daily commutes to and from work. And if the employee, runs a few errands after work or they use the vehicle on the weekend, these would all be considered miles that would be personal use. Employers can elect to withhold federal income tax, but at the minimum, they must withhold Social Security and Medicare taxes. The record keeping is left up to the employee and not the employer. If the employee would fail to do the record keeping of this or cannot supply information in the case of an audit, it then becomes 100% taxable to the employee. So with this personal use of auto, Eide Bailly does put together a booklet every year that goes into a lot of detail in regards to the personal use of auto. We're going to kind of just go through the different 3 calculations, but this, like I said, this book does go into a lot more detail than we'll go through on this webinar. And here's the address. It just is on our year-end landing page where you can find this booklet that you can download to your desktop and just have it for a reference when needed. So like I said, there's 3 methods different calculations that can be used for the personal use of auto. The first one is the commuting value method. This method, you value the employee's personal use by $1.50 per one-way commute or $3 per round trip if the following conditions are met. The vehicle is owned or leased by the employer. The employer, for non-compensatory business reasons, requires the employees to commute to and or from work in the vehicle. The employer has a written policy prohibiting the employee from using the vehicle for personal reasons, and the employee is not a control employee. So that's method one. Method two is the annual valuation method, and this is probably the most common one used as it doesn't have the requirements like the other two methods do. For this method, you determine the fair market value of the car and then the IRS annual lease value tables for the right to do the calculation. You'll calculate the percentage of personal miles driven for the year and then use that to calculate the value of the employee's personal use. And remember, if the employer pays for gas, then 5.5 cents per mile personal miles then needs to be added back for each personal mile driven. And then finally, method three is our cents per mile valuation. Currently, the mileage rate is 56 cents per mile. The rate for 2022 has not been released yet. We usually see this come through probably sometime in December, probably mid to late December. But remember, if you're using the special accounting rule that we're going to track November and December miles from 2020, we have to remember that the rates did change January 1. So for 2020, the mileage rate was 57.5 cents per mile. In order to use this method, there are a couple of conditions that must be met. The vehicle must be driven at least 10,000 miles annually. And then the fair market value of the vehicle when first put into use cannot exceed the luxury car value. And for 2021, that value is $51,100. And within that personal use auto booklet that I said was on our website, there is this employee information sheet that the employees can fill all this out in regards to their vehicle, what they drove, what the odometer was at the beginning of the year, what the fair market value or the purchase price was, and they can turn this into payroll that they can use then to calculate the annual lease value to add back to the employee's W-2. Group term life insurance. Employer provided group term life insurance valued at $50,000 or less is a tax-free benefit to the employee if it's provided in a non-discriminatory fashion. Anything in excess of that $50,000 is taxable wages to the individual. It is based off of the employee's age as of the end of the year. If you do offer a dependent group life insurance, the value over $2,000, anything over $2,000, the entire amount is taxable. You don't get to exclude the first $2,000 like you do with the $50,000. For it to be non-taxable, the beneficiary of the policy has to be the company, a charitable organization, or it is a termed employee due to a permanent disability. So like I said before, the coverage less than $50,000 is non-taxable, and for dependent coverage, anything less than $2,000 is not taxable. It is subject to federal and FICA taxes, but you're not required to withhold federal tax. It is exempt from FUTA, and the tax amount goes in on the W-2 in box 12 with the code C on it. So here's the uniform premium tables that's based off of the employee's age and the cost used in the calculation. And we do give you that calculation down at the bottom there on the bottom of the slide. So you can see it's the group term life coverage minus any $50,000 that's excluded, times the 0.001, and then times your group term life cost factor of based off of the age. If you only add this on at year end, you have had employees term, and if you had employees term throughout the year, this is where if they don't have a paycheck to add this on, then you have to gross it up and the employer is paying for the taxes on it. So kind of a good practice is either know if an employee terms that you add this onto the final check, or we see this done that people just add this on to every paycheck of the year. So you don't need to worry about if anybody would term throughout the year that you've done that taxation of every paycheck that they've had so far. Supplemental tax rates. What the supplemental tax rates are used when paying supplemental wages. This is where it comes in handy, especially this time of year where you have bonuses that are being paid. The federal tax rate is at 22%. And if it goes up to 37% for wages paid over $1 million. One thing to note that supplemental rates vary from state to state. So if your state has income tax You'll want to make sure and check out, see what those rates are at. So the gross up wage formula, this is used when the employer is going to pay the taxes on the taxable value of the fringe benefit. The formula is 100% minus employee taxes equals your taxable income. So for example, here we have the 100%, and then our federal is at 22%, Social Security is at 6.2, and then we got Medicare at 1.45, so we got our 70.35% is used for our calculation. One thing to note here, you do want to note that if you have an employee that's over the Social Security wage limit or is a Medicare high earner, this formula will change with that in order to do the gross up correctly. So here's an example of the gross up here. If, so let's say that an employer receives a $100 gift card, if the employer is paying the taxes, we do that calculation, we take our $100, excuse me, and divide it by the 70.35%, and we come to gross wages as being 142.15, and you can do check your math by doing the calculation there to make sure that you net $100 that you originally started with. And then on the right hand side is where you have the employees paying the $100, it's not grossing up, and you just tax it down to derive at that. So then we come here to deceased employees. This is where hopefully most of you don't have to deal with this, but we just wanted to kind of bring it to your attention because we've had to come up where questions of this needs to be paid any differently. And there is some specific rules that need to be addressed with the deceased employee's pay. So if the payment to an employee after death, but is in the same year the employee died, you need to withhold Social Security and Medicare taxes, and then it gets reported on the W-2 only in boxes 3, 4, 5, and 6. We do not want to show anything in box 1 on the W-2. And then payments to employees after the year of death, we don't report anything on a W-2, and you do not withhold Social Security or Medicare on these payments. Form 1099 miscellaneous box 3 needs to be used, so just make sure it would be using that and not the 1099 NEC form. Payments made in the year of death or after the year of death, it gets recorded on there. And then payments made to the estate or beneficiary also needs to get recorded on the 1099 miss in box 3. I'm going to now turn it over to Jillian to talk about vendors and 1099s for successful year-end planning.
Awesome, thanks, Kate. It looks like I have control, and I went a little fast, so hold on. All right, so with respect to vendors and preparing for year end, probably the very first thing you should do, and hopefully you've done this long before year end, but to figure out if you have an employee or an independent contractor. So then this slide's a lot of words here, but it's just kind of the common law test information from the IRS as far as like the rate to control. So kind of look through these criteria if you're in question on if someone's an employee or an independent contractor, and kind of figure out if you fit several of these in one way and it feels employee, or if it's several the other way and they feel independent contractor. It's not like you have to meet 5 and automatically you're good, or you have to meet all 20. This is just some criteria and it's case by case. So always kind of make a memo if there's ever a gray area on why you decided this person is what they are. And that'll at least give you a leg to stand on if you get called out on it by the IRS. But you guys can read these later. This is just information for you. So you've decided, oh, we got a little poll here. Let's go ahead and answer that. You've decided that you have an independent contractor, which is great, and that's what I'm going to talk about. But if you are unsure, I just want to read through some things here that matter if they're an employee. So the IRS requires withholding as an employee and not as an independent contractor. That's federal withholding. Some states have issues as well. The employer is required to pay Social Security Medicare tax for employees, and if they're an independent contractor, the contractor would pay for it on their own. Many employment statutes, Fair Standard Laborers Act requirements, as well as wage statutes apply to employees, such as minimum wage or the salary limits and overtime and such. Those don't apply to independent contractors. So if you get caught in a situation where you had an independent contractor, that's how you're coding someone and they were an employee, it could be a very expensive mistake to fix because you would probably be due all these taxes as well as penalties and interest and things on those taxes, and possibly additional pay if you're paying them underneath maybe minimum wage or some things like that. So just be aware. And back in February of 2010, IRS started doing random audits on employers to just see if they had employees versus independent contractors. I'm guessing based on how busy they are, the number of audits has slowed, but it's still something to be aware of and keep your eye on. So the first thing to do when you decide if you've got an independent contractor is to get the W-9 prepared. The W-9 is the form that you would request they fill out as the independent contractor, or anyone you pay really. If you pay someone, you should get this W-9 for them so that you make sure that you either do or don't need to send them a 1099. And if you do need to send them a 1099, you have all their appropriate information. Once you've received this W-9 back from the vendor, it's really important that you review it. I like to say right away, in case you can't read something or something doesn't make sense, you can ask them right away for an update, versus waiting until January when you're trying to do way too many things and trying to call these people back because you can't read what they wrote could be a big issue. But on line 1, that's the name they should be using that matches their tax return, and that would be the name you put on the 1099. Some things to watch out with this box is if they say Joe's Plumbing, yet down in part 1, they give you a social security number, that will cause a problem with the IRS because Joe's Plumbing actually isn't tied to that social security number. What they should do is put Joe Smith in box 1, Joe's Plumbing in box 2, and the social security number down there. The same with the other way. If they put at the top Joe Smith, but then they give you an employee identification number, I would verify with them that that makes sense. One way you could do this is to do TIN matching, which I'll talk about in a few slides. As far as box 3 is concerned, it's really important that they select a box, and that if they selected the LLC box, that they put if they're a partnership, a corporation, or an S or a C corp. And that's important because certain 1099 rules don't apply to corporations. And if they just mark LLC, you're not going to know if they're taxed as a corporation or a partnership. So you'd likely want to issue them at 1099 anyway. And then, like I said in the very beginning of this slide, can you read it? Do you know what the digits are in the social security or the TIN? And then did they sign it? Because if they give you a form, it's unsigned, and the IRS calls you up 2 years later and says you have the wrong number here, they didn't sign it, it's on you versus on them for filling it out wrong. Some best practices for a W-9 collection. I like to make sure you get this W-9 before you pay anyone, and you can do that for the instructions. Hold the first check to them for the W-9. Obviously, people don't like that, which is why it creates that need for them to fill out the form so they can get their payment. Sometimes, and depending on the industry or depending on who you're working with, it could be a good practice just to send an annual letter out with the first payment requesting an updated W-9. It's not often someone changes their social security number or their name, but they might change their address, or they might change their status if they were an individual and finally they decided to become an S corp or something. So just sending out those letters once in a while to get an updated W-9 if needed is a great way to do that. Also using a TIN verification program, as I mentioned, this will help you because if someone gives you Joe's Plumbing and a social, you can run it through the TIN match. It likely won't match, and then you can go back to them and say, I TIN matched your information, it didn't match, please update this W-9. And you doing that on a regular basis is way cheaper than getting a notice from the IRS and then having to go through and figure out which are wrong, how to get them corrected. You can't find Joe anymore. There's lots of issues if you wait. So doing it right away is great. And sometimes if you have a hard time getting a hold of, let's just keep saying Joe, you could TIN match. And if it matches, like if you can't read something, if it's a social, you can't fully read, you think a 7's a 4, you're not sure. If you TIN match and it's wrong, just try your other option and see if that one's right. Sometimes it saves you a phone call. The TIN matching process through the IRS usually takes 24 hours though. So I would definitely do this before January, or just call them obviously and get it handled. And then if you pay corporations, most of the time you don't have to do 1099s for them because that's part of the rules. There are certain boxes that require that, and we'll talk about that later, but using corporations more often than not will reduce the amount of 1099s you need. And then paying vendors with credit cards or other third-party payment systems will also reduce your need for 1099s in certain areas because they will get a 1099K from Visa or PayPal, for example, and you don't have to issue them a 1099. This is just a screen showing you the application for TIN matching if you decide to do it through the IRS. So you have to apply to access and then you can TIN match later once you've applied and been accepted. And you can also use third-party software applications that can do this a little quicker than maybe the IRS. At least the process to get signed up is quicker. They do usually cost money, but sometimes it's organized better. It's in a software where you can issue 1099s direct from there. So it might be a little easier to use a third-party software than the IRS, but the IRS is free. And then I would also say during this time of the year, just start running reports and entering all the data you have into your accounting software. So you make sure you have it all by January. If your accounting software allows the checkbox for a W-9 being received and allows the check or the information of entering the social and possibly what type of 1099 you need to file for them, like entering all that data in now and running reports to see what's missing and contact people is a lot easier than trying to go through stacks of W-9s in January. Also, if all of your information is in the software, a lot of times you can connect with an online 1099 filing program directly. QuickBooks Online, for example, will connect directly to quite a few 1099 software programs and file, e-file, mail, email, all of that stuff will just be filed for you. But it hinges on the fact that you've been using your software correctly and you have all the TINs and all the information entered correctly in your software. So it's a great way to save a bunch of time in January to do some of this stuff now, have it all ready to go, reconcile your January bank statement, and then push out your 1099s. Some e-filing updates, just kind of wanted to throw this out there. If you're going to do e-filing on your own using the IRS Fire website, you don't already have a TCC code, I think the last letter stands for code, but you need to get that first, and that will take a little bit of time, and then you can register for the Fire system. This is new. It used to kind of all be in one application, but now you kind of have to do the two-step. So get on that right away if you are going to need to e-file and you're going to use the IRS Fire system. The IRS Fire system, again, like with TIN matching, is free, but you have to have an application that creates the it's not a spreadsheet, it's a notepad file or a text file that looks like the IRS needs it to, which is all laid out in publication 1220 listed there. But it has to look just like that in order to be accepted for e-filing. A lot of times those programs cost quite a bit of money or they're just clunky and hard to use. So a lot of people will decide to use an external system where the IRS receives the filing correctly, but it's done through a different system. So maybe a cloud-based system online where you just type in information and it creates those text things in the file or in the background for you and e-files them for you. You don't have to get your own TCC code, TC code. They have those codes, they do all the filing. A lot of times they'll mail them for you to the recipients and e-file and everything. So those can be great, but they do cost money because obviously that program is mailing and e-filing and doing that work for you. But those are kind of the two options for e-filing. But just to be aware, the Taxpayer First Act of 2019 reduced the total e-filing requirement from $250 per type of return. So if you had 55 miscellaneouses and 245 NEC forms for 1099s, you could paper file both of those because each return was under 250. Well, starting in 2022, which would be these forms for filing coming up, it's 100 is a limit for all forms. There has been a little asterisk in the instructions about, this isn't completely final, but it seems to be pretty final for me. It's from what I'm reading. And in 2023, the limit is 10. So if you're not e-filing now, you likely will be in 2023. So if you want to practice this year, because you have 97 total returns, it's a good time to at least get stuff in motion, but definitely by 2023, most people will likely have to e-file. And whether that's using that Fire site or whether that's using an external software program that will get it to the Fire site for you, you're probably going to have to e-file. All right, we're going to switch gears here completely to year-end compliance. So we've survived through December and now it's in January and we need to comply with all these rules for IRS and Social Security Administration and such. So I will start with forms 1099. And just the basics on 1099s, they are required to be prepared by the payer. So that's the entity taking the deduction on the tax return. So personal payments are not required to have 1099 reportings. I'm not deducting when I have a kiddo mow my lawn. So I don't have to do that as a 1099. Payers also though include entities that don't pay tax. So technically governments don't deduct payments, but someone else should be recording that income. So anybody who is paying is likely on the hook for a 1099 in their course of business. There are lots of different due dates, requirements for recipients, minimum amounts, lots of different things per form. So just review the instructions on the forms. I'll go through some of the most important basic ones here, or maybe the most used forms here, but just pay attention to there's differences on the forms, not huge differences, but some are $10, some are $600, some are $20,000. So it's a good idea to just understand what you're doing so you don't miss something. I talked about the W-9 already, but that's kind of the base form to get all the information you need to prepare your 1099s aside from the amount. And if you're not getting appropriate information from a vendor or recipient, someone who you're paying, then you should start doing backup withholding on those payments to them. The IRS gives you kind of an oopsie year, and then if they see that you filed a 1099 twice in a row with no federal ID number or an incorrect or no TIN or an incorrect TIN, they will expect you to start doing backup withholding, and then they'll just send you a bill saying this is the amount you missed and this is your backup withholding due. So then you have to go through and either amend your forms with the correct TINs or pay some backup withholding. So it's best to be in front of that by getting W-9s and by doing TIN matching. Who needs a 1099 form would be sole proprietors, partnerships, LLPs, and LLCs, depending on how they're taxed. Obviously, there are some instances where corporations do need a form, but in general, corporations don't need a form except for a few items. Most noted are attorney's fees and medical and healthcare payments. LLCs, you have to ask them how they're being taxed. So that is that spot on the W-9, but a S Corp or partnership would not, an S Corp or a Corp would not need a form, and a partnership would, except for those cases when corporations get forms, obviously. And then tax exempt entities do not need to receive a form. They do, however, need to prepare forms. And when in doubt, just research your issue and make a memo. So in a few years, if you do get an audit or a notice from the IRS that you have a reason that you did or didn't file a return or file a 1099 form, and at least you're not going to get negligence penalties. You might get late penalties if you needed to file one, but at least it's not that you were just negligent. You actually thought about it, decided you didn't need to send one, and move on. I can hardly remember what I had for breakfast. So in 2 or 3 years, I probably won't remember why I did or didn't make a decision. So making a memo is always a good idea. Some general, very general information here. This does not apply to everything, and this is not all inclusive, but if you withheld any taxes for someone, you should be preparing a 1099. So even if you paid someone $250 and you withheld 10% because they requested that you did, so you are below the $600 limit in rents, for example, you still need to prepare the 1099 because you had withholding. $10 or more in royalties, interest, dividends, and retirement plan distributions. 600 is the main number that we see, and that's almost everything else. On that 1099K, it's $20,000 and 200 or more in transactions, or 200 or more transactions via a credit card. Someone would receive a 1099K. That'll change in 2022 to 600, which I'll talk about in a few. And like I said, this list is not all inclusive. These are just kind of the main ones that people will come up against. Here's a quick summary. Oh, another poll. Here's a quick summary of due dates. And I've only included the electronic filing due date here because realistically, likely everyone's going to be there in the next year or two with that 10 limit. But if you're not electronically filing, it's generally the month before. So February 28th is usually the paper filing due date to the IRS. March 31st would be electronic filing due date. A few things to point out: the recipient copies are almost always due January 31st for most of these forms, so they can get their tax returns prepared. And then for the NEC box right there in the middle, for NEC form, that is due January 31st to the IRS and January 31st to the recipient. The IRS is not messing around with NEC. And so those are both due on the 31st. I have heard rumors that they're trying to move most dates to both be the 31st of January at this point, but it is not finalized, but just something to be aware of for the coming years. So a little bit on the form NEC, 1099 non-employee compensation. This is a new form as of last year, so old news now, but just kind of a refresher. It's for 600 or more in services, cash payments for fish, and payments made to an attorney in a course, your normal course of business, not for proceeds or settlements. That's on the miscellaneous form. The $600 or more, and you have to file that form for each person who you had withholding. So as I mentioned on that other slide, if you have $500 but $50 withholding, you still need to file the NEC form. And then just a note on this, the combined federal state filing is still in process for this form. So it could be that by January 31st, they're good to go, or by January, hopefully not the 31st, by January 10th or so, and the fire system opens up, they're good to go for state. But if they're not, you still may have specific additional state requirements for these NEC forms, depending on what the states want. This is just a quickie preview. For the miscellaneous, that's the other main form we see. That would be royalties, etc., rents, other income, that's a big one. And these other items listed here. Again, the $600 limit does not apply if you have withholding. So if you have $200 and $20 withholding, you still file this form. And this is kind of just a quickie of the form. So the main difference from the past couple of years is that non-employee compensation is no longer on this form. It has been moved to the NEC form. And that was because the NEC is due earlier. So instead of having the miscellaneous, the NEC on this miscellaneous form and having to file this form at 2 different timeframes, the IRS, they've moved it to its own separate form. I talked about the 1099-K a little bit earlier, and this is for any payment card or third-party payment transactions. And so for 2021, forms filed in 2022, so this year we're heading into here, the limit is still $20,000 and 200 transactions. So if you paid someone with Visa, PayPal, anything like that, they would get a 1099-K if they hit 20,000 or 200 transaction limit. Venmo, probably Cash App, I don't know, some of those others, there's a million now you can use that you pay. They will not issue a 1099-K because they don't fit the description of third-party network transactions or payment cards. So there's still times when you think you're paying with something that might fall under that, but it actually won't. So either research which ones you're using and which ones still require a 1099 from you, because they will not get a 1099-K, or when in doubt, just probably issue your 1099 NEC or miscellaneous or whatever. And then we'll have to deal with that later if they get a 1099-K as well for the same income. And just as a note, I mentioned earlier, the rules are changing for 2022. So forms for 2022 due in 23, that limit goes to $600 like the others. And that's something to pay attention to a bit, because if you're issuing something, a 1099 currently to a vendor, they might not get a 1099-K if they didn't have more than $20,000 and 200 transactions. And maybe next year they all of a sudden are, above 600 and they're going to get a 1099-K. You've sent them a 1099 NEC, and now they have duplicated 1099 income in the IRS's eyes. So they could get a notice about that. And it could be you could be that vendor receiving a 1099-K as well as 1099s from other vendors or other people who pay you. And so you just need to be aware, kind of pay attention to your 1099-Ks and what's going on there, and make sure you don't want to double report income, obviously, but I have seen people getting notices generally in the area of a restaurant or like a beauty salon or something, where they would have tips and tax and their income all reported on the 1099-K, and obviously sales tax and tips are income to them. So they don't report that as income. Then they get a notice because their 1099-K was higher than their income, and they just have to explain the differences, or sometimes amend and increase their revenue by the tips and tax and then take a deduction for tips and tax. So just something everyone needs to be more aware of in the future when those limits reduce. But in general, you don't have to send a 1099, miss, NEC, etc. to someone who will receive a 1099-K for that income. So in your system, you're tracking what kind of entity they are, what you're paying them for, how much you paid them, and how you paid them. It is kind of a big burden, but all those things will need to be tracked in order for you to appropriately file your 1099s. Here's just a little blurb on some of these other basic forms we see often. Just a little tidbit, the $10 in interest is only if you're like a financial institution. If you just issue, or if you're just paying someone interest in your business, the limit $600. For 1099 dividend and 1099-B, Those could apply to shareholders. So if you have a corporation and you're issuing dividends or sales or something within your entity, you could have to file those Div and B forms. Maybe check out the instructions to make sure. It usually doesn't apply to S Corps, but it would apply more to C Corps. A 1099-R is something that is seen a lot for retirement plans. So if you're managing your retirement plan, you could have to be issuing those forms. If you have someone managing, they're likely doing that for you. And then 1099-C is generally only required by organizations who are in the business of lending money. So you could possibly have a vendor who you extended credit to. They ended up not paying you. So you wrote off, you canceled their debt. That wouldn't be a 1099-C situation necessarily, but is it a 1099 miscellaneous because now they've purchased something from you and they didn't have to pay for it. So, I mean, there's a million situations where that could be something or something else. So just pay attention when all of a sudden you are reducing someone's debt. You're not in the business of lending money, so it's not a C, but it could be a different 1099. I wanted to do a quick summary on penalties. The type of penalty doesn't necessarily matter, but you guys can review these if you would be issued a penalty. So that's usually if you filed an incorrect return. When I say return, I mean 1099. Maybe you filed on paper when you should have done it electronically. You didn't have a TIN number or you issued the wrong TIN on your 1099. Maybe you didn't provide all the correct information by the appropriate date. And you don't have a reasonable reason for that. There's lots of reasons you get penalties. These are the basics on 1099s. And then I just wanted to show you the quick penalties for this year coming up. As you can see, if you're a small business, it's 5 million or less. A large business is 5 million or more in the last 3 years of average gross receipts. And the penalties are the same, but the maximums are different between small and large businesses. But if you intentionally disregard, meaning you just don't file your forms or you don't file a certain form, it's $570 per return, no limit. So that could go up and up and up forever. That's why it's a good idea to always make a memo of why you did not file something, because you would be stuck at that $280 per return with a limit versus the $570 per return with no limit penalty. Just a quick bit on corrections. If you need to correct 1099, sometimes you have to do 2 corrections, sometimes you have to do 1. And if you're correcting a type 1 error, that's if you had the amount wrong. So the TIN, the name, all of that's correct. You just needed to say 750 instead of 800. You check the corrected box and just file that form. If you had issues with the TIN or the name, then you would have to do 2 forms. You would file the original information that was incorrect for the corrected box and 0 that out, and then send a second form that's kind of the original form with the updated information. So I correct the social, and that's my second one, but it's not corrected because it's an original form for that social. It's mildly confusing, but hopefully you can read through these slides later if you have an issue. I'm going to pass it back for some COVID reporting and answer some of the Q&As.
Thanks, Jillian. I was just going to mention that, saying that we're going to move back into the payroll realm. So Jillian can answer some of these questions. I tried, Jillian, as much as I could to answer your 1099s, and I'm leaving the rest for you. So good luck to that.
Thank you.
All right, so there has been a lot of changes for compliance reporting for payroll due to COVID credits. And we wanted to just touch base on some of these as, a year end, knowing that we have quite a few that have expired, and, just kind of make sure we're reminding everybody what is expired, what is due, and then how are we reporting this coming into the end of the year. So the first thing we're going to kind of be going over is this ERC credit. From a payroll perspective, you're using those wages to calculate qualified, wages per quarter, and then the reporting for all employers is based on the 941, is where you have to report it to receive or record it to be receiving these credits. Now, the ERC had a big kind of announcement this last week that, in the infrastructure bill, that they are showing that they're going to be sunsetting the ERC earlier than what we had been hearing as 12/31, that they're sunsetting it on September 31st or September 30th, so that they can, if the president signs this, then it's going to be sunsetted, even though before we had reported it was 12/31. So the thing that they do have out there is that eligible startup companies can still claim the credit in fourth quarter However, it's going to be capped at $50,000. So I know we're kind of been watching this to see what we can release on this, and that's just, give you guys a heads up that Q4 may not be available to most of our employers. So with reporting for the ERC, current quarter is obviously going to be the best way to do it. Getting those qualified wages on that return, especially if you're e-filing it. We are seeing the greatest success on getting those refunds back if it's e-filed on a current quarter. If you are paper filing or having to do your 941X for previous filed quarters, the IRS is lagging terribly on those 941Xs and getting our employers refunded back those credits. We are starting to see notices and responses now for the IRS from 2020 and earlier 2021 for anything with a 941X. But just knowing that you have to use those worksheets that are located in the 941 instructions because you are required to report those non-refundable and refundable amounts on the 941 or the 941X. Also, do not forget, because we are seeing some people who did these on their own, that you have to put in qualified wages or health plan expense on part 3. And if you are not recording that, the IRS is not processing your 941X and telling you to do it over. So watch those types of things. The worksheet did change for just Q3, so we can strike out the whole Q4. So even when we were putting this presentation together at that time, we were still thinking this was going through Q4. And 2020 to Q2, you would use one worksheet because it's based off the non-refundable for the employer Social Security. And then you're moving it to the 941 for Q3 is now going to be using a different worksheet, which we're going to go over the worksheets a little bit later. But just know that you do need to use the correct worksheet. As we do 941Xs, or if you're doing 941Xs, biggest things that we want to make sure we point out to you guys is do not change anything unless it's required to be changed. So if the number was good and you're not doing any kind of adjustment to it, do not put it on your 941X. Part 3 about the wages and the health plan expense, we want to make sure that you guys do record those. The non-refundable, refundable has to be filled out with that worksheet. You do not send in the worksheet, but you do have to figure out the difference between the two. Make sure you're using the correct quarter. The revision dates, you'll see, I'll have a slide up showing you how many different 941s there are. Make sure you're applying the correct quarter to the right return. And then if you're doing a paper return, make sure the top, a lot of people do not see this, do not forget to put your employer name, your identification number, and then your quarter of the year that you're doing. And then also just understanding the part 1 and part 2 of the first page of the 941X. Here's an example of just that. The top picture is just at the top of every single 941X, or if you're doing a 941 through like irs.gov, this is what you need to fill in on each page. And then also knowing your part 1 and what you need to select. So part 1, question 1, adjustment employment tax return versus the claim. Are we rolling forward the credit or are we actually applying the credit? The date we want to make sure that we point out is that, the look back, you have 3 years to amend a payroll return. However, once you put the enter the date, you discover the error, you have 90 days to make this correction. So make sure you're watching the date that you put in here, and then also selecting, are you rolling forward the credit or are you asking for a refund? For most of these COVID credits, we are doing a claim just so that we don't have to apply it to the next return. Part 2 is just making sure that you align yourself. If you answer part 1 with question 1, then you have to fill in number 4. If you answer with number 2, you have to fill in number 5. And this is just making sure, is your employee aware of this? Did this affect your employee or not? So then we just talked about the ERC, the FFCRA, which then rolled into the ARPA. It has expired as of 9/30, but there could potentially be that you guys will still report this on Q4. And what we mean by that is if you had an employee who was out sick as of 9/30 using COVID pay, that you potentially probably didn't pay them until your first check in October. So then the IRS recognizes the fact that they earned it, but you didn't pay it. So then those credits would roll forward into Q4. Now, also making sure then that you report this on your W-2 in box 14. Easiest way to report it, put it in box 14. Otherwise, you do have to provide a special statement to your employees with the W-2 saying that they had qualified sick or family credits that they had applied for the employer. So expired 9/30. No pay for that, and anything 10/1 earned is not allowed. The COBRA premium credit. This is something that was new with the ARPA, April 1st through September 30th. If an employer paid an employee's COBRA for loss of job, hours that were reduced, change from full-time to part-time, took a leave of absence. So you would fill out worksheet 5, and just remember the 941 does flow from the worksheets, what you need to report. And you do have to put in there the individual, like how many individuals, employees that you paid for. All right, the employer payroll tax deferral. This was a big thing from 2020, but what we have for 2021 is we have our first payment that's due on December 31st. So coming into December 31st, we talked about that's a weekend, or we might have some weekend dealings. So then it's going to be the first day that, January 3rd or something like that. So just kind of watch when December 31st falls, because we have been kind of butting up against weekends. But the first 50% is due this year, with remaining amount due next year. So making sure that you are paying those back. We'll have a slide coming up here in a couple about showing you how you need to pay them back. And if you haven't paid them back in that direction, make sure that you're contacting EFTPS to change that. Along with the employers deferring, the employee got an opportunity to defer theirs if the employer determined that they wanted to offer this to their employees who qualified. They call it the payroll tax holiday, and that was from September 1st of last year to December 31st. What we need to make sure that you guys are watching for this year is that the collection of deferred tax from the employee was from January 1 to April 30th, but now it was extended to December 31st. You would have reported both the employee and employer deferral on the 941s from last year. And then how the IRS is knowing that you paid them back is based on how we're going to make the payments through the EFTPS. But with the employee, there was a little bit more, maybe I'd say a headache for the employers. So just want to make sure we point out the fact is that if the employee quit, you, the employer, is responsible for the repayment of the entire deferral amount. And once those deferred amounts are paid, you have to go back to 2020 and do a W-2C to correct the Social Security wages and Social Security amount that was paid in by the employee. So there will be a W-2C from the prior year that has to be completed. So the payment I was talking about is that at first, coming into January, February this year, we did not have this button that the EFTPS just put out here, this deferred Social Security tax. A lot of people were paying it through that federal tax deposit. Some people were claiming that as a payment on Q1 2021. So the IRS came in to make this a little bit easier for them to determine if you did pay this back timely, because if you don't pay it back timely, we are going to have a big penalty to have to deal with, because they'll go back to the original due date of when that tax was due if you do not pay it timely. So what the IRS came in with EFTPS and said, put this button in here for the tax type selection, so that if you actually did this fourth quarter of last year, you need to go into EFTPS, select the deferred Social Security tax applied to Q4 2020. Make sure you're not applying it to current year. Otherwise, you will not show it as that you paid timely. Kind of talking about the 941 form, just to show you guys how much we've had to learn over the last 2 years. Employers, payroll softwares, any type of payroll providers. We've had 5 different revised 941 since 2020 that has changed, and then has changed at the last minute. And then also having to wait for those instructions to be released have been something that's kind of, maybe had us pulling our hair out a little bit, because you had to learn, relearn, learn again. And then you had to wait when you would normally start your quarterlies, and then you would have to wait for them to release the new form. So 5 different revisions. Pat yourself on the back if you have had to go through and learn each one of those. With those revisions, we've also had worksheets. So for 2020 and Q1 of 2021, we had 1 worksheet. Coming in with the ARPA, starting with second quarter, it went to 5 worksheets. And so you have to make sure you watch your dates. Anything, if it was paid before April 1st, was it paid after March 31st? You know, we had the COBRA premium that came in for the 2 quarters. And I'm expecting if this, you know, thing goes through with the infrastructure bill with the ERC with Q4, I have a feeling we're probably going to be seeing something different for Q4 coming in with instructions. 941, you know, one of the biggest things too that we see with clients with questions or IRS notices is really understanding your 941, line 12, and your 13A. Line 12 is your total payroll tax liabilities. Line 13 is what did you pay? So those are your deposits. So liability versus deposit. Line 12 is very important for the fact is that when you have to report on your Schedule B or on line 16, if you're a monthly tax depositor, I highlighted it. Those are like your monthly or your per payroll liabilities. The IRS knows when you paid. They get it through the EFTPS or through if you're still low enough to pay with your return, they can see the date you paid. What they want to see here is, did you pay timely? So these are your liabilities, not your tax payments. You know, so they're just going to line that up when you paid it to determine if you did pay it timely. And if you didn't, you will receive an IRS notice showing that you have a penalty. So just always kind of watch that line 12 has to match your Schedule B or your monthly breakdown. Line 13 is how much did you pay in for your tax? So coming into January with our W-2s, we have a kind of a smaller section on this one, but what we want to make sure we just kind of really push is that last week of December and that first week of January, I think are probably the hardest of a payroll person's life, because trying to end a year and start a new year at almost at the same time is quite tricky. Making sure that as you come into the end of December, do we have all the final things for those last paychecks? Starting January, if you have an early check date, you need to make sure that your software is up to date for 2022. So you're kind of doing both ending and beginning a new year at the same time. So make sure your software is updated. That reconciliation, we cannot stress this enough about how important it is to reconcile your quarterlies, even down to your payrolls. Making sure that those things balance at the end of the year. I always like to say, like, I like to know that when my W-3 ties to everything for the year, is like putting a nice shiny red bow on it and saying, oh, good, we're done. Now let's start over again. Looking at your due dates as we're coming into the end of the year. Last year, you know, we kind of pushed out a lot like, hey, your due date's actually February 1 because January 1st was on a weekend. You know, this year we're coming back to January 31st being a Monday. So just know what your due dates are, your annual state returns. You know, unlike, you know, Jillian's dates, you know, a lot of ours are January 31st. So with the, you know, the SSA, because that's where the W-2s go, you know, 1099s go to the fire, the IRS, SSA is where the W-2s for us go. January 31st, this was moved quite a few years back, that both the employee and the employer copy to the SSA are due January 31st. If you are doing a third party recap form, the 8922, that one is due the end of February. So looking at your federal, we know it's the 31st. Most states are reforming to the 31st. I kind of went through in our W-2 book that we are posting out there for you guys. We have all the state deadlines and most of them have moved to January 31st. A few odd ones like February 15th or something like that. And then as Jillian's talked about too, the W-2 count, we were kind of joking, it's been 250 for as long as I can remember. And all of a sudden they're like, okay, how about 100? And then let's just drop it down to 10. We're like, wow, there's really no warning there. So we're kind of watching that. Like you said, there was a little asterisk down there saying, you know, if the IRS does not, you know, approve this, then it's going to revert back to 250, but we're kind of watching it and kind of going with the movement forward that it's 100 for e-filing. Same thing as Jillian's with the you know, the penalties. You don't want to be caught not sending in your W-2s because it could be very costly to your company. And then also, like, especially if it was intentional with the no maximum on there. Reconciliations. I am an advocate for really pushing out getting reconciliations done. Sometimes it feels like, why do I do this? It always just matches. The software should know this stuff. You know, why do I have to tie this out? It is so important for you to tie this out because, I mean, from your payroll reports on a per payroll basis to your quarterly returns to your annual returns, all of these things have to equal out. So when we come in and enter in that W-3, that difference better be zero. And if it's not, we're going to probably be receiving some sort of an IRS notice or a state notice. And so having to go back to fix something in Q4 can be very time sensitive. You know, we don't really have extensions. You have 31 days to produce those returns into the W-2s. So you want to make sure that in Q4, if you realize that something happened in Q2, that's going to take a lot of fixing to go backwards. So every single quarter, always tie out your year to date. You know, Q2 ties out, does my year to date tie out? So really kind of pushing those reconciliation forms. You know, this was kind of way back from the very beginning, talking about gross versus taxable. You know, reminder to your employees, do not use your paycheck, your last paycheck, to do your tax return. You need to understand what taxable wages are, what the pre-tax, you know, cafeteria plans, retirement plans. And also, if you're a company that doesn't put your taxable fringe benefits on until the very end, especially if you do gross ups, you know, that might not even be on their last pay statement. So you want to make sure that just understanding gross versus taxable, like what gets reported in box 1, 3, 5, and 16. And you kind of see from this example, the pre-tax health reduces all boxes, where the retirement only reduces federal and state. Now, that's not true for all states either. So just kind of knowing what state you're in can help you understand, is box 16 actually, do they allow those pre-tax cafeteria and also retirement plan? Some new limits for 2021 to watch for. You know, we always kind of throw out that box 3. This should be one of those like, oh, this would never not do this, but trust me, we have it here because we do see some people that I didn't realize my software wasn't updated, or I did an Excel spreadsheet, you know, and, you know, those things can kind of, you know, tamper with those limits. So box 3 for 2021 is 142,800. If those wages are higher than that, your W-2 will be rejected from the SSA. Box 10, we always used to joke about wanting this number to be increased, but this year they actually did. So since I've ever seen box 10 on a W-2, it's always been at that 5,000 at the max. For 2021, it is 10,500. We are waiting to see about 2022, but for this year, it can be up to 10,500. Box 12, just a few of the codes that, you know, we really want to just point out to you that we have these limits here. So don't report higher. 401k Roth, you know, we got the code D or code AA. Regular is 19,500. If you're able to have the catch up at 6,500 additional. Our 408p, which we call our simple plan, code S, 13,500, and catch up 3,000. You know, something I always try and stress to anybody who does their own payroll, make sure you know what plan you have, because if you actually have a simple plan, but you set it up in your software with a 401k, the code will be wrong, and so will the limit. So just be very careful that you are knowing what you are setting up in your payroll software. Health savings account, this is another big one. You know, employee versus employer. You know, we have to be able to report in the box 12, the code W, both the employee, if pre-tax, and the employer portion of the HSA. You can have one code W that adds them together, or you can list them out separately if that's what your software does, but don't forget to include the employer portion of the HSA. Employer provided health coverage, you know, this is one of those questions that if they're changing the e-filing number from 250, will we see this number change too? Because it's kind of aligned with that e-file number. So with the ACA, you know, for previous year W-2s, so in 2020, if you did fewer than 250, you are not required to report healthcare on that W-2. But if you had more than 250 W-2s last year, you do need to report the healthcare, both employee and employer portion of health on box 12, code DD. So it'll be interesting to see if we see that number drop next year. One of the things that we put out there for, you know, you guys is, you know, a benefit. You know, we put a lot of time into these, that we want to make sure that you guys have these resources, is that out on our website, you know, we really, you know, put something towards this year end. We have year-end compliance books, we have W-2 books, we have 1099 books. We also have personal use of auto books, you know, just so that you guys can have some of these tools at your fingertips. And also, if we're doing the service for you where we actually provide you your W-2s and your 1099s, we have the forms out on our sites so that you guys can fill them in and then upload them to us through the Eide Bailly, so that we can get your information. You know, the sooner you get it in, the better. we like to encourage people to have that to us by January 10th, so that we can get you and either your recipients or your employees their information timely. So here's just a couple things for you guys to see out from our website. Here's the guide. This is exactly what it looks like on our website. So I took a screenshot of this for you guys to see it. Is, we do a deeper dive on understanding your Form W-2, your 1099s, the person use of auto, like I said, it's got some toolkits, stuff that you guys can use for your employees to fill out, so that you guys are ready to do that final calculation to put on their paycheck. All right, so we kind of talked about how do we prepare for the end of the year, how do we survive January, making sure that everything ties out and we report correctly. So at the same time as surviving January, we have to start the year off right, because if we don't start off right, we're not going to end very well either. So we just kind of wanted to throw a couple of things out there for you guys, just reminders about what do you need to prepare for in January. So quarter one, unfortunately I said January starts quarter one, but it's also reporting of the year end. You want to review and test your software updates. That first payroll that you produce, make sure everything ties out correctly. Like I said too, for reconciliations, we have our quarterly reconciliation, but we also do a per paycheck reconciliation. You can find so many things if you do that reconciliation on a payroll basis. So just make sure that everything is looking good and if it's set up correctly. Kate mentioned too about the W-4s. Anybody who claimed exempt, you need a new W-4 by February 15th. So make sure we have those. And then that look back period, very important. The IRS usually is pretty good about sending you a letter saying that you went over the threshold of the tax liability. So now you have to make your payments more frequently. But you can also kind of just see that based on those reconciliations to see what was your tax liabilities. And then did anything change with your business? Did the ownership change? Did you change it, from one entity to another? Those types of things are important just to make sure that you're communicating those out so that when you come in to report maybe your unemployment and now you have a new, shareholder, a new owner, that can be set up appropriately. So just make sure you communicate those things because it does affect our payroll, especially when you're an S corp. If you have a new 2% shareholder and you're offering them pre-tax benefits, it is a lot of work to fix that. If after the fact we find out it maybe in June or July that they actually shouldn't have had those pre-tax benefits. Just a few numbers for updates here is just 2022, 147,000. This is going to be the best year, I think, because, sometimes trying to remember what the last three numbers are is a little tricky. So it's just going to be a nice, easy 147. 2022, they did increase retirement, from 2020 to 2021, they kept everything pretty stalemated. So you'll see that we do have some increases coming up to 20,500 and 14,000 for the simple. Catch-ups remain the same. House savings account, we'll see an increase of the $50 and $100 for the family. And then also, this is where we have projected, we want to make sure that we point projected because they have not released yet as of today what 2022 for dependent care and flex spending is. They're projecting it for flex spending to be $2,850, and for dependent care, they're trying to determine if they're going back to 5,000 or if they're going to allow that 10,500 to go forward. Payroll updates for transportation, very similar. I'm kind of wondering if these things will have any type of change, knowing a lot of people are working remote or working from home. So it's gonna be interesting to see if they change these, but right now they're projecting them to increase to $280 for both the parking expense and then the transit passes, vouchers, tokens, and fare cards. And then Jillian, if you want to take this slide quick.
Yes, definitely. So I just want to do a quick summary of, now that we've survived January, what we need to do for going forward. And I kind of mentioned most of these things earlier, but the IRS e-filing limit will drop to 10. So probably a great idea to get ready for that for the 2023 filing in January. And then the backup withholding rate for 1099s in 2022 is still 24% from everything I read. They could update it at any time before then, but at this point it is 22%. So that applies when you don't have the appropriate information from your vendor and you need to start backup withholding. So just be aware of that. And then starting in 2022, as I mentioned, the 1099K requirements will drop from that 20,200 transaction limit to 600. So it might be a good time to go through your accounting software and figure out if you can mark paid with credit card. And then if you run reports at the end of the year, how that looks as far as, maybe run reports ahead of time so you can be sure that you're not including credit card payments to your vendors in your 1099s, or at least do your best not to. And then I mentioned this earlier as well too, but I'd heard some grumblings in a few trainings I attended that they're trying to move all dates to January 31st for 1099s to the IRS, to the recipients, all of them. And that has not happened, but just something to kind of keep in the back of your mind, because it would be a lot of work to get everything done for everybody. So your payroll, your 1099s, all the things. I don't know if I have control of the slides.
No, I do.
Okay.
I was just gonna also, just before we, kind of wrap this up, just mention too, like, in the COVID area, I really didn't talk much about the PPP, mostly because from a payroll compliance reporting, that's not something we report on the 941 or the W-2s or through an employee's paycheck. But one thing that they, just to put out there is just remember, for all these credits between PPP, ERC, or the FFCRA, ARPA, and we have the whole alphabet, I think now at this point, you can't double dip. So the biggest thing just to understand is that if you went for the PPP and got forgiveness on wages that you put out there, then you can't use those same wages for ERC. And the same goes for the FFCRA, is that you have to be very careful and strategic about what you use for the wages for which credit. Because some people we're looking at between the ERC and the PPP, like how we maximize the best credit for employers. And, we have an ERC team that works, very hard on looking for the best thing for the employers to look, to get them the most maximized credit back. But just so you guys know that you cannot double dip on those wages. So just kind of put that out there for you guys. I'm looking through a last few of these, questions that have come up, and, as I'll actually click through the slides, because I know we got some questions. We got some webinar series for you guys, and I know at the end of this, here is information on all three of us, that if you have questions that we weren't able to get through, or it's something that maybe, triggered a question. I know you guys have the slides, and I know we recorded this webinar also, that if you guys have follow-up questions, that you guys can reach out to us. But yeah, so I'd say, I'm not sure if there's any more questions that we need to answer, Jillian, unless you see something that you want to answer.
I'll try to type a few in the next minute or two, but if we don't get to them, like Angie said, just feel free to reach out. Lisa, that stock warrant one feels a little loaded, so why don't you just email me? That would probably be the easiest on that one. We can go back and forth. And as far as the ERC majority owner question, that is still not allowed. Anyone with family that's an owner is still not allowed, as far as I know. So hopefully that answers Roy's question. And I'll try to type up something on this rent one. I haven't read that one yet because it just came up a few minutes ago. So we'll try to type on these. If they end the webinar and you don't get an answer, definitely, as Angie said, reach out. It has been good talking with you all. Hopefully we answered some questions that didn't create more questions for you. Have a great rest of your day. Anything else, Angie, Kate?
Nope, it is as you said, if you have questions and we weren't able to answer them, let us know, and we'll reach out with you guys, and hopefully you guys have a successful year end in January.